Markets cheer it. Markets fear it. And almost nobody can tell you what it actually does. Quantitative easing. QE for short. Now this part is reportable. Major central banks really did run QE. Big rounds of it in 2008 during the financial crisis, and again in 2020 during the pandemic. That happened. But what does the word actually mean? Ask around and you'll mostly hear one phrase: money printing, inflation, the central bank just conjuring cash. That's the headline everyone repeats. The reality underneath is quieter and stranger. QE isn't a helicopter dumping bills on the street. It's a swap. The central bank trades freshly created reserves for bonds, and by doing that, it eases financial conditions across the whole system. So before you cheer or fear, let's walk the mechanism, step by step. Here's the actual move. A central bank can create reserves, electronic money, essentially out of nothing, and it uses those reserves to buy bonds, mostly government bonds, out in the open market. When a buyer that large shows up and keeps buying, two things happen. First, the central bank's balance sheet swells. To put illustrative numbers on it, the Federal Reserve's balance sheet sat around $1 trillion before 2008, then climbed toward $4 trillion across the crisis rounds, and went far higher after 2020. Those figures are illustrative, just to show the direction and the scale. Second, and this is the key, buying bonds bids their price up, and bond prices and yields move in opposite directions, like a seesaw. So as the central bank pays up for bonds, their prices rise, and their yields tend to fall. Demand created from almost nothing lands right on the bond market. So why does buying boring government bonds move stocks? This is the part people miss, and it's the heart of QE, the portfolio balance channel. Think of it as a loop. By buying up safe government bonds, the central bank removes them from the market, leaving big investors, pension funds, banks, asset managers, holding cash that now earns almost nothing. They don't just sit on it, they go looking for yield, and that pushes them out along the risk curve, out of safe bonds and into corporate credit, into stocks, into riskier assets. As that money flows in, those asset prices tend to get bid up too. Meanwhile, the lower yields QE created ripples straight into the real economy. Cheaper mortgages, cheaper corporate borrowing. The demand the central bank created from nothing doesn't stay in the bond market. It circulates outward through the whole financial system. There's a second engine running alongside the buying, and it's almost invisible: the signal. When a central bank launches QE, it isn't only moving bonds, it's making a statement. It's telling markets, in effect, that policy is going to stay easy, low for long, for a good while yet. And markets price the future, not just the present. So once investors believe rates will stay low, longer-term yields can drift lower on the expectation alone, before the central bank buys a single extra bond. Picture a yield line easing gently downward. That path is purely illustrative, just to show the shape. This is why economists argue the announcement can matter as much as the purchases. So QE works partly through plumbing, the actual bond buying, and partly through expectations, the promise that easy money is here to stay. Before you treat QE as a magic wand, hold all of this loosely, because it has real limits. First, the reach. QE tends to lift asset prices, stocks, bonds, housing, more reliably than it lifts the real economy of wages and jobs, which is why critics say it can widen the gap between markets and Main Street. Second, the fade. The punch of each new round can diminish as markets come to expect support and the easy effects get priced in. And third, the exit. Putting QE in is far easier than taking it out. Unwinding the balance sheet, quantitative tightening, can rattle the very markets QE soothed, and it rarely goes smoothly. So is QE money printing that guarantees inflation? Not exactly. It's a powerful, blunt tool whose effects depend on the economy it lands in, how long it runs, and how carefully it's withdrawn. So, here's the takeaway. Go back to where we started. QE, the central bank that creates demand from almost nothing. Now you have the chain to read it with. The bank creates reserves and buys bonds. Bond prices rise and yields tend to fall. Removing safe bonds pushes investors out the risk curve into stocks and credit. And the whole time, the signal anchors expectations toward low for long. That's the plumbing, the whole quiet machine that started in 2008. But hold it loosely. QE lifts assets more than the economy. Its effect can fade, and the exit is hard. None of this is a forecast, and none of it is advice. It's a lens for reading a noisy headline. So the next time someone shouts that the central bank is just printing money, look past the slogan. Don't fear the printing. Watch the plumbing.